Thanks everyone for starting to log on. We're going to give everybody just a couple minutes to get on here and then we'll start. All right, we're just going to give everybody 30 more seconds and then we'll get started. All right, my name is Cece Mortar and I'm the programs manager for the Steamboat Springs Chamber. I want to give a quick shout out to our sponsors that make the business education series possible, including Employers Council and Northwest Data Services. As we go through this presentation, know that we'll stop and ask questions in the middle and at the end, but feel free to put your questions into the Q&A and the chat feature as they come across your brain. And then I would like to take just 1 minute to introduce our speaker today, Catherine Peterson. Catherine has been lending in the Yampa Valley for 20 years. She's worked closely with local deed restrictions, down payment assistance programs, and she's taught real estate continuing education classes for over 10 years. She's been voted the best of the boat, best mortgage banker for 10 years in a row, and she loves to help our locals purchase their piece of the Yampa Valley. So with that, we've got a lot to cover, and Catherine, I'll let you take it away.
Great. Thank you so much for having me. It's always good to be able to help out whoever we can own their little piece of the valley. So if you do have questions, feel free to put them in the chat. I've got some slides that I'm going to go through a little bit and would love the questions and interactions. So just feel free to ask anything that comes up. So I'm really what we're going to go through today and what Cecilia and I went through is just 5 things to kind of know if you are planning on purchasing down the road, whether that be in a year, 3 years, 5 years, just some things because it's never too early to start. So that's really what we're going to cover today. So a little bit about me, we've really worked hard on helping out our local population. And so we love to use all the programs that we have available. And one of the things that we find as we're meeting with people is loans are very different than you may think. So there's lots of changes happening all of the time, and we have some examples of it as well. But to give you a quick, just like kind of down and dirty with loans, because just going through loan products would take many hours. So I'm just going to touch on a few things. So a lot of people think that you have to have a fair amount down, but there are programs that don't require a down payment depending on income, or they require less of a down payment, which is also great. So you can sometimes get away with a very small amount down. And so those are things just to be aware of, is that it may be easier to achieve homeownership than you think. And some programs are more affordable and they're changing all the time. So to give you a quick example, you guys might have seen this release here recently where where FHA mortgage insurance premiums, which is just a fee that they have you pay monthly because you don't have a huge down payment, those went down by about 30% in costs. So that helped out a lot of homeowners. And this is the press release with the link in there. But overall, it can be getting more affordable in some ways. So just be mindful that even if you got a pre-approval 6 months ago, it might be different today, but these things are always changing. So I want you to just know that really the only way to evaluate where you're at is to meet with somebody. Okay. Also, there is a local down payment assistance program that you might have heard about that I'd like to bring up because some people don't know about it, and it's through the Yampa Valley Housing Authority and provides up to $20,000 to use for a down payment. And that's something we utilize a lot as well that people don't always think about. So just know that there's more options, more programs. Things are very different than I think what people hear on the street. So that's why it's important to actually kind of like take that step to figure that out, even if you're not there yet. Okay. Number 2, and here's the information on the down payment assistance program. Please never make an assumption that you can't purchase. We do have some people who come in and say, oh, I never thought I would be able to purchase, and we qualify them and they're like, oh, I wasn't expecting to actually get pre-approved today. So they're in a very different situation than they thought. Their credit's different than they thought, lots of things. So don't ever exclude yourself from thinking that it won't work. Okay. All right. I don't think any questions so far? Cece, do you see anything?
No questions yet.
Okay, perfect. Good, good. All right. So number 2, we're going to need your stuff. And what's important and what I find is that sometimes people are like, well, I knew that you probably need some things, but I throw everything away every year, or I shred it all every year, or I don't keep any of my stuff, or I don't know how to access my financials. So it's good to kind of keep control of these, save your taxes, save your W-2s, save your paperwork, just because those items we will need at some point. So it's good to have them handy. And there's definitely lists out there of kind of in general what lenders need. Sometimes you can get all that stuff online, but it's easier if you just kind of start to continue it and keep it and have a system to keep it now while you're in the pre-purchase process, we'll call it. And normally we don't request more than 2 years, but occasionally it's 3 if you're doing like a business loan, something like that. And just to throw it out there, I always recommend that people keep 6 to 7 years in case you get audited. So you want to keep them anyway, not just for mortgage, but please, please, please keep your hand on those things. You'd be shocked how many people don't have those, and that's okay, but just keep a copy for yourself. Also, some things that we use for documentation is that I like to bring up in advance is changes in how you get paid can hurt your mortgage loan approval. So for example, if you've always been a W-2 year-round full-time employee and you switch to seasonal right before you come in for a mortgage loan, that's going to hurt you. Or if you were W-2 and you decide to open your own business, that can there can be some waiting periods involved. So you want to be just a little bit cautious on that. I'll sometimes meet with people who say, oh my gosh, in anticipation of purchasing, I wanted to make more money, so I went out on my own and I just did that. And I'm like, oh, now we're gonna have to wait a little bit to get some history in the business to show that the business can be profitable. So just know that those changes can hurt things. If you're switching from, let's say, office job to another office job, that's okay. But it's sometimes good to run anything that you do by somebody. So it's good to kind of have that person that you can ask on your, let's say, personal board of directors, somebody that you can call and say, hey, I haven't even talked to you yet, but I'm thinking of doing this change. Will this hurt me down the road? So, and we get it. Sometimes you have to take a step that's going to be better for you later, but it's just good to know what that means on the pluses and minuses side. What we don't want is for you to get super excited about a house, come in, and then you've done something that you think is helpful that it's not. And I hate to break that news to somebody. So we're trying to get the word out about that now versus tell you when you come in. I also hear a lot that seasonal income people can't get a mortgage loan, and that's just not true. We do loans for people who are seasonal all the time. The key is the consistency of it. So if you're brand new seasonal, that could be difficult. But if you've always, let's say, done the mountain and then a summer job restaurant, and you've kind of done that same back and forth, that's okay. And that's income that we can use. So it's important just to be aware that those things can be helpful to be consistent on. So what's tough is if you take a summer off or you take a winter off or you instead of doing mountain restaurant, you switch to mountain river or something that's different. So the more consistent you can be in that seasonal income, the better. But seasonal people get loans all the time here, so don't let that set you back. Again, save all your stuff, because sometimes then we'll need more paperwork. So we might need then the W-2s, but we might also need the last paycheck stub, even though it was back in, you know, if we're looking at your stuff in the fall, we might need your last paycheck stub from the mountain that you had in April, or we might need to contact the employer to get that information. So again, the more that you have, the better, and it's easier for us to calculate out that income. Okay. All right. Now let's talk a little bit about credit. Again, this is another section that we could spend a whole lot of time on, so I'm just going to cover it kind of quickly. So the important thing with credit is that you're looking at it, is that you know it and you're familiar with it and you can see what's on it. So there's a few different ways to check your credit. It should always be free. Annualcreditreport.com does give you access to your credit very frequently, and it gives you access to all 3 reports. It doesn't give you access to your score. And that's okay, because the score you see online isn't the score that most mortgage people see anyway, but it does give you kind of a gauge if you can get to your score. So Credit Karma is another good option where it's on your phone. You can check it every day. If something pops up, you can put yourself on notices so that you can say, hey, I'm keeping a really good eye on my credit and I know what that looks like. Again, if I had my wish, I would meet with everybody a year or 2 before they purchase so that we could get their credit in line, their income in line, and all of that, because we do see that people sometimes can do things they think is helpful for credit that's not. But the first step in that is keeping an eye on your credit and really knowing what's on there, because there can be stuff that pops up that isn't yours or you didn't know about, so you didn't know that you had to pay it. So things like that are just important to watch. Also, when you're checking them, be sure to look at the whole report, not just the score. So you can see the whole report in both Credit Karma and annualcreditreport.com, where you're looking at each individual account, looking at the history for each of those, etc. There's some little tips like you can pay down your credit card debt, pay it twice a month as you're coming into a big purchase to get a little bit better score, because remember, credit cards only report to credit once a month. And so there's some ways to do that as you come into a purchase that we can kind of review with you, or any mortgage person can review with you. What's kind of key is if you have questions that you're, again, meeting with a mortgage person to go through that. Hey, what should I do on credit to be ready? And a lot of times people don't need as high of a score as they think they do. Both conventional and FHA have are pretty flexible on credit now. And recently conventional, which is just Fannie Mae, Freddie Mac loans, so normal loans, changed their guidelines to give better pricing to people with lower credit. So we're seeing more buyers able to use conventional loans, which cover a broader spectrum of properties and can be less expensive than other loans like FHA. So really things are changing for the better for a lot of buyers. So that's great news. Also, be really, really cautious about new debt. So we are seeing that something like a $700 a month car loan, and I get it, you may need to buy a car, try to get that monthly payment down, reduces what you qualify for in a mortgage by $110,000. So let's say your plan is to purchase something down the road and you're like, hey, I would love to be able to purchase at this amount. And that is going to impact, if you go out and get a new car loan, it's going to greatly impact what you can afford. So sometimes you're better to hold off on a car purchase to try to just fix your old car, or if you do need to get a new car loan, to have that payment be as low as possible, but also keep in mind how much you're going to be paying for that car over time. We also see people with things like side-by-sides and four-wheelers and snowmobiles, and any of those monthly payments will change what you can afford in a house. So those are super important to be mindful of as you come into a purchase, and just avoid as much debt as you can. Hey, Cece, any questions?
No questions yet.
Okay, all right. Feel free to ask them here. One of the things that we look at as we evaluate kind of what you can afford, and obviously knowledge is power, is we look at how much you bring in monthly. So we talked a little bit about the income piece of things, and we look at the expenses that you pay out every month, like car loans, credit cards, etc., and the new housing payment. So so that's essentially what determines your affordability on a home. So obviously things like rates, which we are in a higher rate environment, have made more of a difference on what you can qualify for, but also those debts make a really big difference. So kind of if somebody comes in and says, oh, I want to be able to qualify for more, we're saying, okay, let's work on getting down your debt, up your income, or increasing the down payment. There's also one other option that we're seeing and using out there, which is called a 2-1 buy down. And this is very confusing, so stick with me a minute. Basically what it is you ask for a credit from the seller, and we use that credit as a subsidy. So it goes into an account and it sits there, and every month a little bit of that moves over to help you pay like it's a lower interest rate loan. So essentially it offsets your payment. So your first year, if it's a 2-1 buy down, would be 2% less than the market. So let's say your rate was 6.5, you'd start at 4.5. You'd pay that for a year with the subsidy, and then at 5.5, and then it just goes to the normal rate of 6.5. So it's still a fixed rate loan, but it does give you a little bit of rate relief, which hopefully will bridge the gap until rates come down a little bit. Okay, so that's just a seed to plant in your head. It obviously depends on how competitive the offer is, how if there's a ton of other offers, obviously that might be harder to get that buy down, but we are seeing it fairly frequently. We are doing that a lot to help people kind of get comfortable. They still have to qualify at that higher payment, but it just gives them a little bit of relief in the middle. And then hopefully if rates come down, they can refinance. So that's just something to be aware of. Okay. Another piece that I already brought up, but I'm going to bring up again, is about credit card balances. Those can make a really big difference in credit. So as you're coming into a purchase, the lower those can be compared to the limit is better. And the other thing is we also look at each card versus the limit and the total credit cards versus the limit. So I do see that occasionally people will close a whole bunch of accounts coming into a mortgage application, which can be harmful for their credit. Sounds backwards, but what happens is because we look at the total and because we look at age of credit, if you're closing old cards that you've had for a long time and you're getting rid of the credit limits, that can hurt your score. So just some things to just be cautious about on both the credit and the debt. Very, very important. Okay, looks like we might have a question. I'm going to click on it.
Although we are eligible, our monthly payments are coming back at an outrageous amount. What can we do to lower that other than putting down a huge down payment?
Yeah, that's a great question. So one of those is that 2-1 buy down option. So let's say the seller is doing a that you can do 300 and the list price is 300. Well, what if you offered 310 and got a $10,000 credit? We can use that to do that buy down, which lowers the monthly payment for those first couple years. So that sometimes can give you a relief. So even though you qualify at that higher payment, it gives you that lower payment until you can get to where rates are lower. So that's a way to kind of do the same thing. The other thing that you can do is down payment assistance. Can it be helpful for that? Because if you can use that down payment assistance, that does lower your payments. The other thing is you can look at just an interest rate buy down. Also, it's good to look again because there were so many changes that happened in the last few weeks that we're seeing that like between the FHA premium and the conventional guidelines changing, we're seeing payments have come down. Also, conventional has a program called Home Ready, which is essentially it gives buyers that have income under a certain amount a discount on their interest rate and a discount on the mortgage insurance. So we're seeing that that is also helping people with monthly payments. So if you haven't looked recently, I would say to do it again. Last, we have seen rates come down a little bit. So that's going to be the other question that I just want to go through, because that does involve the debt ratio. So, and hopefully that mostly answers that question. But it's hard. Some of it's just strategy, and some of it's also looking at budgets and saying, hey, let's talk about what you can afford. And because keep in mind, when you purchase, it fixes your housing payment. So sometimes people are like, well, I need it to be less than rent. Okay, great. Let's kind of mess with that a little bit and say, okay, yeah, but you've been saving money for a house. So let's say if you're saving at $300 a month, and now you only have to save $150 a month because you're in the house now. And let's look at what that looks like. Or have a couple months where you test a payment and you say, okay, right now we're paying $1,500, but I think we could pay $2,000. So what if we put $500 aside in a savings account, just see how that feels with our lifestyle and what that does to our spending, because sometimes there's more room there than you may think, and just testing it a little bit can really help you feel like, oh yeah, now I get it. We are okay. But every household is different. And I tell people, even though I'm not the one that has to make your payment, so I can give you the payment, but that doesn't mean that it's going to be comfortable for you. So it's important to really understand what your expenses are, because some people spend more and some people spend less, and some people want to put more away for retirement, and that's okay. So we kind of have to fluctuate that a little bit depending on what the comfort level is. But I have seen people able to kind of massage their comfort level depending on using different programs and doing some practice months. So
Perfect. Thank you.
yeah, and I'm going to get into the rate piece a little bit here. So the question we're getting a lot is, when are rates going to come down? And it would be awesome if I was like, they're going to come down on this date, but that's a little bit tough, especially with the global economic situation that we've had. So overall, rates will come down when inflation comes down is the answer. When is inflation going to come down? Well, that's the hard thing to answer. But we do feel like we will get some relief at some point. So inflation does go up and it does go down, and that's normal. So the key is we put a bunch of money out there. We're going to have inflation, and relatively rates are still fairly affordable. It doesn't feel that way because we haven't had rates at this level in a while, but the normal rate is about 7.5 if you look at the beginning of time. So we are really still in a pretty good level overall, and we do feel like we might get some relief. Are we going to go back to 3? I would like that, but I don't think that's going to be possible. And part of that was that the Fed was purchasing mortgage bonds for a very long time, and that was keeping rates artificially low. Okay. And then what happened is they stopped that at about the same time that they started increasing the Fed funds rate and inflation started hitting. So it was like everything at once. So they went up really quickly because they had been held low. So it like ballooned up really quickly. So we do think it could come back down quickly when it does, but we do need to show that inflation is controlled before that happens. And why is that? So inflation is basically how much you pay for stuff. So is it increasing or decreasing? What does your grocery bill look like? What does gas look like? What's housing look like? So the more that they can bring inflation down, so let's say I loan you $10 and you're going to pay me back $10, but you're not going to pay me back for a year. If inflation is high and you only pay me back $10, I'm not going to even be able to buy the same thing with that $10. But if, so then I'm going to charge you interest because I want to make money and I want to cover inflation. So the higher inflation is, the more the interest rate has to be. We're in a super funky situation right now because Wall Street Journal Prime is at 7.75, at least right at this moment. It probably change tomorrow. But mortgage rates are in the 6s. So it kind of shows you that right now the 30-year rate is lower than the long-term rate and things are funky. So it's best just to reach out on any of that stuff. But also when the Fed increases the Fed funds rate, that's an overnight rate. That does not mean my mortgage rates go up. So what happens the day of the Fed is people are like, oh, I hear mortgage rates are going up today. And I'm like, no, that's the short-term rate. So long-term rates are based on 30-year mortgage bonds, which trade every day based on what's going on in the world. So they are moving up and down constantly throughout the day. That's what we're watching as far as mortgage rates. So very different. Normally on Fed days, my rate actually goes down. Super counter, like doesn't make any sense. But for a whole economics class, CMCs, but that kind of gives you the basics of it. So the key will be, you can always get in now as long as you can afford it and plan on refinancing down the road. You want to still make sure that payment's comfortable for you today, but it's just something to kind of think about a little bit, because there are, if inventory does come up, you have a little bit better option. We're seeing a lot less cash buyers, which is great for home buyers right now. So, okay. I think that's the same. Can you chat about buying a home with someone? CC, I'm just reading it. Is it different married versus not married? What if one person has lower, higher credit that's different, but both parties will be paying the mortgage? That's a great question. So basically what happens if you're purchasing a home with somebody else is we do look at then both the income, both the credit, both the debt. There's different loan programs that look at that differently. So sometimes we're taking an average of credit, and sometimes we take the lower of the two. So if someone has a lot lower credit, there's some really easy ways to get their credit up. And again, starting early is best. That can be pretty quick. But it is helpful because if scores are really off, that's where it's going to be difficult to include them. And we can't include their income without including them on the loan. Okay, so it's going to be important to get them kind of in line. And so that's going to be huge. You don't have to purchase with somebody. So just because you're married doesn't mean you have to buy a home together. You can buy the home in just one person's name or the other. There's no rule about that. And also you don't have to be married to buy a home together. That's another thing that we hear a lot of, is you can just be dating. I bought a house with my now husband when we weren't married, so it's certainly possible and has been forever. And so again, even though there's two people who might be paying the mortgage, we really need them to both be on in order to count that income. So again, another reason why it's really good to work on credit if you can, so that we can count both of those incomes in there if we need to. So. Okay, so hopefully that answers that one. I love the questions though, keep them coming. That's what we're here for. Okay, cash is not king. So this is like what I wake up in the middle of the night having nightmares about, is this thing, this and adding a car loan right in the middle of a transaction. So basically, one of the things I really want to push into you is there's some things that the longer you do, the better. And this is one of those that I wanted to get the word out early on. So we sometimes will need to show that you've been paying rent, and some loans require it, some loans don't. But if we do, that means we're going to have to prove that you're paying rent monthly. So we're going to look at your bank account. We're going to look at, hey, here's the checks that show that you've been paying rent for a year. And so if you're paying that with cash, that gets really, really difficult to prove. Occasionally we can show that you took the cash out and put it in your landlord's account, but a check is way easier. The easier that you can make that on yourself and us, the better, because sometimes we need that rent history, and if we don't have it, that can make the loan a lot harder to get. So if you aren't doing that now, start paying your rent with a check, 100%. Or a transfer or something that's provable out of a bank account. Okay, money orders are difficult. Cash is difficult, things like that. So the more that you can do that with a bank account, the better, which means get a bank account if you don't have one. So that is really, really important. The other thing is that some people are better savers if they just shove it under their bed in that box, right? But that is difficult, again, for us to prove. So the more cash you can keep in a bank, the better. They want to make sure that we're sourcing all deposits There's laws around this. So it's not that we're saying, hey, we're picking on the cash people, but we also need to show where the down payment comes from, because they want to make sure that you're not getting money from me, from a party who isn't able to contribute, that the seller is not giving you some outside incentive that we don't know about, that your realtor isn't loaning you the money, that it's not a loan. So things like that are important to prove. So we do want that down payment in a bank account. You can get down payments from gifts from parents, siblings, relatives, things like that. But then we're showing where that money comes from. So again, just the more that you can use verified sources for the down payment, for rent, and sometimes even for debt payments, that can be helpful, because if someone has no credit, we might go back and say, hey, show us that you've paid utilities for 12 months. Well, again, if you're paying that with cash, that's going to be really, really difficult to show. So that's one thing we do. Okay, we have another question. Yay. So is debt to income included when determining your monthly payment? I was approved at a certain amount. Is that is more than double our rent? We thought it was only based on interest rates. So basically your rent doesn't impact your debt ratio, because the rent will be going away. So it's really the what you can afford with a new house. And basically it's we'll say, okay, based on your income and based on your debts, this is what you can pay. So even though we might prove that you've been paying rent on time, that is going to matter less in how much you get qualified for than the new payment. So the interest rate does impact that qualifying more so than your actual rent payment. We just want to show that you've had the history of paying rent. So kind of two different things, and it is confusing. So you are correct. It is definitely more based on interest rates and that total payment. Also, there's some things like, obviously if you're buying a condo and you're looking at a place with high HOA dues versus low HOA dues, that's going to change your affordability as well. So let me know if that didn't answer the question, but I think I got that one. So, okay. All right. And so again, meet with a person early. Occasionally we'll meet with someone and they'll say, oh yeah, I have all this cash. It's at my house. I've heard glove box. I've heard storage unit. Don't do that. But get that into a bank, because that's where it really needs to be for us to be able to show that it's yours and that it's your cash. So the earlier we can have that conversation, the better. Okay. Real estate. For 5, real estate is a winner over time. So we're having this conversation a lot, as well as, well, the market's been really good for a while, so it's going to go down. And that's not always the case. So I saw this chart the other day and I thought, ooh, this is perfect for what we're going to talk about today, because if you need a place to live and you're going to pay rent anyway, that's where it really starts to make sense to look at purchasing, especially if you're going to be in the home for a while. So will it go up every single year? Not necessarily, but over time, it's a good investment. So imagine if I said, hey, there's somebody who's had a record of 73, let's just pretend it's the Broncos. I'm a Bronco fan. 73 winning years, 7 losing years, 1 flat year. You'd be like, ooh, that's my team. And we'd all be super excited if that was the Broncos, because I know that's not the case. But if anyone can pull up their record, that would be great. But that's really good, and that's real estate. So 73 winning years, 7 losing years, 1 flat year. And so if you look at this chart a little bit more in depth, this goes back to 1942, and it shows the year-over-year appreciation. And 1955 was flat. There's some years that it's 12 and some that it's 1 and some that it's 2, and it kind of builds over time. And there's obviously some that are down, like 1990, 1991. Good years, good music. And then this is where the yuckiness happened, right? But look at the years ahead of that. They were good. And also there was some really good years back in the 70s where it did go up and it didn't go down. So you have to kind of keep that in mind. Yes, we've been in a winning streak. We do predict that most likely things will be relatively flat. And so we're hearing a lot, and I'll kind of go into the why a little bit on that. But overall, the key is buy and hold, you need a place to live anyway. So that's kind of what we're explaining to people, is it's a winner over time and it's a good investment over time, but you also need a place to live. So that's kind of an important thing to keep in mind. And this chart, I think, really helped me kind of think through it a little bit and look at it, because that's pretty good. So all right, let me go and show you guys this. So this is what we have, something called a real estate report card that we can send out. I'll give you the contact information if you want it, but this kind of looks at historical over the last 63 years. This is Routt specific, so our county. Shows the 10-year and it shows the 5-year average per year appreciation. And then it shows the prediction, and this has moved around a little bit. It was closer to 0. I've seen it closer to 2, but they adjust it each month. So right now they're still predicting a 1.84 increase in real estate year over year. And then this is a cumulative, so don't get scared about this, but this means, you know, moving forward, we do anticipate values to continue to rise. But the why behind that is, if we look at inventory, so think toilet paper, right? We all remember when we could not get any in the grocery store and what happened to prices? Way up, right? Eggs, price up. Well, right now we're very, very short inventory, and we will be for a while. There just hasn't been a lot of places being built, and that is hurting us and will continue to hurt us. So this is a little something that shows, hey, here's what we've been building, and this is what we need. So we're missing all the little boxes without checks in it is essentially a visual on how we're short inventory. There are some areas in the country that have more inventory. This is not one of them. So even in the worst, even in some markets, we're seeing values come down a little bit, but not really that much. So and some of those were definitely some overexcited markets. So we just haven't been seeing that here. And you'll notice now when something pops up on the market, there's definitely interest in it. So we aren't seeing a whole lot of things sit very long. Obviously things can change, but we are in definitely a different environment because everybody is really getting good loans. There's more savings, there's more equity. So people really don't have any incentive to foreclose right now because you can sell your house for a lot. So until we see home equity go down and things like that, we're just not going to have the foreclosures. There's a foreclosure report that I watch, and statewide, there's just not a lot. So I'm just not anticipating things to turn drastically. Are we seeing a reduction in appreciation? Yes. Am I seeing prices dropping? Not really, unfortunately. And fortunately, I guess. So, okay, Q&A. Can you speak to using a retirement account for down payment for a first-time home buyer? What are the pros and cons? So that is a really good question. It depends a little bit on the retirement account. And I'm not a tax advisor, but so I always suggest people talk to a tax advisor. But there are some incentives where you may not have to pay tax. You could also look at on the withdrawal. You can, and your 401k or your retirement account administrator can help you with some of those questions as well. But the other piece of it is you're still pulling money out of retirement. So I like to have that discussion with people to say, let's see what it looks like with and without pulling out money and how that impacts things. Because sometimes you don't need to do it. And if we can avoid it, that's my preference. But also I've seen people utilize a 401k loan. So if you're still at the employer, you can sometimes do a 401k loan where you essentially loan the money from yourself. And it's a really good way to do that without taking money out. You're kind of borrowing it from yourself and then paying it yourself back with your paychecks. So there's some ways to structure that just depending. I also think it depends on what are your retirement goals? Are you going to be retiring soon? Are you how much you saving in retirement? So there's lots and lots of different things to kind of look at besides just boom, should I deplete my retirement account? Or instead of taking all of it out, should I only take out a very small amount just to get me into the house? Because there's definitely some things to keep in mind. Is the retirement account matched? All of those are factors in that question. So hopefully that helps answer it a little bit, but I like it when people retire, so we try to definitely evaluate those pros and cons, but they're very, very person specific and retirement account specific as well. Is it a Roth? Is it a normal? Is it a SEP? What is it? So there's a lot more questions around that, but hopefully that gives you the quick preview. I still like to sometimes see the statements so that we know you have some backup money, and that can be helpful as well, just to know that, hey, there's some money out there that that you can use if something goes really sideways. So a lot of times on those financial documents, we'll ask for the copy of the retirement account statement so that you can, so that we just know that you have extra money, but we won't make it so that you have to take it out or anything like that. But it's just going to depend on the rest of your financial situation. So I would say that, you know, if you're like, the only thing holding me back from buying is an extra $2,000, then we'll kind of talk through that a little bit. Also, we've seen people do creative things like sell four-wheelers, have a garage sale, like lots of things to purchase a house, which seems crazy, but it actually, it can get you there. So we can be creative as you guys want to be as well. So to a point, to a provable point. So great questions. Thank you, thank you. Okay, this is the info to email me if you want the rest of that real estate report card. It's like a big handout that just shows like appreciation over time, average housing price, things like that, just kind of the basics of that. We also have a home buyer guide that we can send out as well that just kind of goes through some of the basics of the do's and don'ts. So we'll include that with it as well if you send me an email. And I'll leave that up for a second. So a few just themes that I kind of want to go through. One, save your documents. B, meet with someone early. Watch your credit. You know, make sure you're dealing with realistic information about the market that you're looking at. The other piece of it that I would tell you to do early that I don't have on these is start to watch the market, the neighborhoods. You can a lot of times sign up through things through a real estate agent, which when you purchase using a real estate agent is free to you because the seller pays. So sometimes you can start watching markets early. So you could say, hey, I just want to see everything that comes on the market for less than 500 or less than 300 in this certain area. And then you can kind of see what's out there and what things you might like and not like, and start to drive around and get used to neighborhoods and areas. Definitely when we were looking at moving to Steamboat 20 years ago, we thought we wanted to be in one area. And then once we actually got here, we were like, oh my gosh, I'm glad we didn't do that because we actually want to be in a whole different area and we wanted to be in Stagecoach. So there's just so much that you kind of learn about a neighborhood by watching the listings and by watching the markets and by driving around and saying, oh yeah, this actually, you know, this neighborhood is way better than I thought, or, oh gosh, I could never live here. And imagine if you make that mistake after. So as early as you can, start to just watch those neighborhoods and watch those homes and those prices, the better it can be for you and in your purchasing knowledge on everything. And again, it's never too early to get with an agent as well. So, okay. So in summary, mortgage options are different than you think, and they're changing all the time. So even if you've done it, it might be worth it to look at it again. Okay. And again, as soon as we figure out the rules, they change again. So being a mortgage person is a full-time job of just keeping up with the updates. Mortgage people will need your financial documents, save your paperwork, all your stuff. Credit and debt are vital to approval. So look at those early and often, watch them, put on alerts. I check my credit probably every week. So there's never too much of that. And cash is not king. Talked about that, which you'd think it would be, but even the people who pay with cash out of a bank. So that's a distinction to make. Real estate is a winner over time. And we've definitely seen that over the last, as long as I can remember in real estate. So yeah, we've been through some yucky times, but that was very interesting and unique situation that I could talk again on a whole other class about. Okay, what other questions do we have? We kind of whizzed through that pretty quickly.
So we don't have any questions, but I will just kind of close out a little bit and give people a couple minutes to put in questions if they have them. Thanks, Catherine. I just want to thank you for being here. You are a wealth of knowledge, and we totally appreciate you joining us and offering that to our members. For everybody on the call, I'll be sending out Catherine's slides and the contact. And just as a reminder, you can reach out to her if you're interested in getting the real estate report card or the home buyer's guide. We will also be hosting another event with Catherine and Michael Marchand at Steamboat Sotheby's on April 6th to dive in deeper to real estate trends within our current economy. So you can come join us for happy hour 4 to 5 on that day. You do need to register, and you can do that just by emailing me at cecilia@steamboatchamber.com. I want to thank our sponsors again, the Employers Council and Northwest Data Services. They help make these events possible. And I also want to encourage you guys to reach out to me if you have any ideas or questions or things that you would like to see a presentation like this on. Our goal is to help you. So any feedback is great. It doesn't look like I have any more questions, but if you guys have questions as they come up, you'll have her contact. You can reach out. You can reach out to me. We're happy to answer them after the fact. But thank you. And thanks, Catherine. Have a great rest of your day, everybody.
Thank you.
Oh, wait.
Reach out if anything comes up. I'm an open book, so.
Catherine is the best. Thank you.
Oh, thanks. Yeah, absolutely. It doesn't need to be scary. So anything that we can help with, we're always willing to. So.
Have a wonderful day. Bye.
Thank you.